Welcome to our deep dive on maximizing college income without jeopardizing financial aid. We will explore how to balance the creator economy's volatility with the need for stability. Throughout, we will focus on protecting aid eligibility, building an emergency fund, investing in yourself, and handling taxes. Let's begin by setting the stage for why stability comes first. Here is our roadmap. First, we will examine why stability beats hype in the creator economy. Next, we will cover the HYSA Rule and how to build 3 to 6 months of cash. Then, we will address the financial aid trap and how to time assets around FAFSA. After that, we will discuss investing in yourself. We will follow with smart investing principles and then a critical tax warning for online income. Finally, we will lay out a 30-day action plan and test your understanding with quick quizzes. Now, before we proceed, we need an important disclaimer. This video is educational and not financial, legal, or tax advice. Financial aid formulas and tax rules vary by country, state, and institution. Always confirm details with your school's financial aid office and a qualified tax professional. With that said, let's move into why stability is your primary objective in the creator economy. The creator economy can pay thousands from brand deals and side hustles, but income is highly volatile. Because financial aid often depends on reported assets, volatility and high balances can hurt eligibility. Therefore, your priority is stability first, growth second. Now, let's translate that into a concrete first move. The HYSA Rule. Your first line of defense is a high-yield savings account. Aim for 3 to 6 months of basic expenses. Automate transfers from each paycheck or payout into the HYSA to steadily build your buffer. Use this cash only for emergencies or sudden tuition changes. If you draw from it, refill it before you invest elsewhere. Once your target is reached, you can direct additional funds to longer-term goals. Moving on, let's examine the financial aid trap and how timing can make or break your reward. This mind map organizes the entire playbook. At the center is the college cash strategy. Branch 1, Stability First, highlights building a 3 to 6 month HYSA, automating contributions, and reserving that cash for emergencies only. Branch 2, Aid Timing, focuses on FAFSA snapshot dates, minimizing visible taxable assets around filing, directing dollars to retirement accounts, paying down debt, and timing cash flows. Branch 3, Invest in Self, covers skills, equipment, courses, platform growth, and monetization. Branch 4, Smart Investing, centers on Roth IRA eligibility, broad market index funds, avoiding speculation with essential funds, and aligning risk to time horizon. Branch 5, Taxes, lists self-employment taxes, bookkeeping, quarterly estimated taxes, and legitimate deductions. The final branch, Action Plan, bundles the next 30 days, review cadence, and contingencies. Financial aid forms, including the FAFSA, effectively take a snapshot of your financial position. Assets and taxable accounts can reduce aid eligibility. Therefore, strategically minimize visible assets near filing dates. Direct surplus cash, where appropriate, toward tax-advantaged retirement contributions or debt payments, which often have a lower impact on aid calculations. Keep a detailed calendar of your school's deadlines. Next, we will visualize this timing with a clear flowchart. This flowchart begins with incoming cash and immediately asks whether the FAFSA filing date is approaching. If yes, prioritize minimizing taxable balances by directing eligible money into retirement accounts and paying down high-interest debt. Hold only the necessary minimum cash in taxable accounts during the snapshot window, then file the FAFSA. If no deadline is near, continue building or maintaining your HYSA and invest surplus according to your plan. After filing, reassess allocations and return to normal operations. The highest return on investment at your stage is yourself. Allocate funds toward courses, coaching, and skill development that directly raise your earning potential. Upgrade equipment only when it clearly increases throughput or quality. Build repeatable systems and workflows. Track business metrics like CPMs, conversion, and retention to decide where to scale or cut. Now that we have stabilized and improved earnings potential, let's compare stability versus growth to calibrate your choices. On the left, stability emphasizes a funded HYSA, predictable bill coverage, lower stress, and protection from volatile income. On the right, growth focuses on reinvesting into your content engine, committing to diversified investments, building layered skills, and expanding platforms. The key is sequencing. Secure stability first, then pursue growth with managed risk.
Speaking of investing, let's formalize your approach with proven tools like the Roth IRA.
For long-term wealth building, the Roth IRA is particularly powerful for young earners with taxable income. Contributions come from earned income, grow tax-free, and qualified withdrawals in retirement are tax-free. For non-retirement funds, favor broad market index funds, such as total market ETFs, which deliver diversification at low cost. Do not speculate with money you need for tuition, rent, or essentials. Next, we will quantify your monthly plan with a simple budget and tax set-aside table. This table offers a sample allocation. Set aside approximately 25 to 30% for taxes, adjusting to your tax bracket and local rules. Direct 10 to 20% toward your HYSA until it is fully funded. Allocate 30 to 40% to fixed bills and 10 to 20% to variable needs. Dedicate 5 to 15% to investments in yourself, such as courses or equipment. Finally, put 5 to 15% into long-term investing like a Roth IRA or a diversified brokerage account once the HYSA target is met. Now let's address taxes more directly, because online income has a unique twist. Online income generally counts as self-employment income, which means you are responsible for both the employer and employee portions of payroll taxes in addition to income tax. Track every dollar and keep receipts to substantiate deductions.
Proactively set aside money for taxes from each payout and, where necessary, make quarterly estimated payments. Use accounting software or a disciplined spreadsheet to stay organized. To visualize how your cash gets split, here is a pie chart of allocations. This pie chart illustrates a representative monthly allocation. 28% set aside for taxes, 15% for building the HYSA, 32% for fixed bills, 12% for variable needs, 7% for investing in self, and 6% for long-term investing. These numbers are examples. Adjust based on your actual expenses, tax rate, and HYSA status. Now, let's convert everything into a concrete 30-day action plan.
Here is a 4-week plan. In week 1, calculate your 3 to 6 month expense target, open a high-yield savings account, and automate transfers. Create a dedicated tax bucket and transfer 25 to 30% of each payout. Record FAFSA deadlines and identify snapshot dates. In week 2, audit your accounts and reduce taxable balances before filing. If eligible, contribute to a Roth IRA, otherwise continue building HYSA. In week 3, reinvest in yourself with a targeted course or skill upgrade, and streamline your content system through templates, editors, or automation. In week 4, select a broad market ETF for non-retirement investing once HYSA is on track, and set reminders for quarterly taxes and monthly reviews. Next, let's see how much you remember with a quick quiz. Quiz time. The question is, how large should your HYSA emergency fund be before prioritizing investing? Option A, 1 to 2 weeks of expenses. Option B, 1 to 2 months of expenses. Option C, 3 to 6 months of basic expenses. Option D, 12 months of all expenses. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video.
The correct answer is 3 to 6 months of basic expenses. This cushion protects you from income volatility and provides the flexibility to manage financial aid timing effectively.
Second quiz. Which action typically has less negative impact on financial aid than holding cash in a taxable account near the FAFSA filing date? Option A, buying single cryptocurrencies. Option B, keeping surplus in a standard brokerage. Option C, contributing to eligible retirement accounts. Option D, leaving funds in a checking account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is contributing to eligible retirement accounts. Retirement contributions are often treated more favorably in aid formulas compared to holding cash in taxable accounts. This timeline breaks the year into quarters. In Q1, you receive tax forms, file prior year taxes, make your first estimated payment, and refill the HYSA if needed. In Q2, the FAFSA window and school-specific deadlines require you to minimize taxable assets while still investing in yourself. Q3 is for growth projects, content batching, your third estimated payment, and reviewing HYSA levels. In Q4, conduct year-end tax planning, verify Roth IRA contributions, make your fourth estimated payment, and prepare documents for the next filing season. Now, let's distill the key takeaways. The key points are as follows. First, stability comes first through a 3 to 6 month HYSA. Second, time your assets around FAFSA to protect aid. Third, invest in yourself for the highest return. Fourth, rely on a Roth IRA and broad market funds for long-term growth. Finally, respect taxes by tracking income, setting aside funds, and paying quarterly where applicable.
To close, let's summarize and send you off with next steps.
In summary, open a high-yield savings account and automate contributions immediately. Mark FAFSA deadlines and plan your asset timing. Choose one high-impact skill to upgrade this month. Set up a dedicated tax bucket and reminders for estimated payments. Finally, invest surpluses responsibly with a Roth IRA first and diversified funds next.
As we conclude, here is a final note of gratitude and a call to action. Thank you for watching. If this video helped, please like it, share it with a college creator friend, and subscribe for more strategies. Share your questions, experiences, and recent wins in the comments so we can learn together.